to 97 bucks. Okay? And your call option, and believe me, I'm making this very simple, and your call option goes down to 2. Well, you can go into the market and sell your option and get some of your money back. Okay, the Forex does not work like that at all. In the Forex market, the money you put up is continually at risk unless price moves. Okay? So, let's say price just stayed stagnant and just moved like this. And let me give it a little bit better. So it moves just like this. Okay? And it's just a few minutes before the report, and your brother-in-law calls you up and says, hey, I just talked to Ben Bernanke, and he's not going to say anything about the market. He's going to keep his tone very simple. And then I talked with a couple of the biggest bank traders out there, and they're not even at their desk. They went to lunch. That means the market's not going to move anywhere. You may not have any value in your option, and that's this resale column. The resale column will tell you how much money you can get back for your option. Now let's take a look at how this can work for you and against you. If you see here, I can recoup almost all of the 50 bucks. I can recoup a little bit less than half. Okay, that's because price has moved. Some volatility has come in. Now when you look at the other two options that I made, look at this one. I put out 500 bucks, but look at what the resale value is. $9.86. That's like you took an option almost to the very brink of expiration, and now you're trying to sell it. Basically, the money's gone. Okay, so keep this in mind when you're trading these options. So again, let's look at a couple of different scenarios. I don't think I got to this yet. 50 bucks on the top is going to pay out 115.04. The 50 bucks on the bottom is going to pay out 124.74. Okay? That's our payout. So let's look at worst case scenario. Worst case scenario is the market trades just like this. In between. And actually the absolute worst case scenario would be the market comes up here, comes in 1 pip here, comes down 1 pip there, and then continues trading. Okay? Just far enough that we don't get paid. Remember, the midpoint, halfway between the bid and the offer, has to trade inside of the box in order for them to pay out. So that would be worst case scenario. What does that mean? We're out the 100 bucks. So that would be a loss of $100. Okay, so our risk at this point is 100 bucks. Okay, erase all that. So we'll put that up here. Risk equals 100. Now let's look at our possible reward scenario. Reward scenario number 1 is up here. Okay, just the market comes up, trades in, and just goes like this. Let's say it stays in this area and goes sideways and just goes right through our box. Now we get paid out on the top box here. Since we paid 50 bucks, we have to subtract that to get our what I would call our true return. So 115.04 minus 50, 65.04 is our profit. Okay, because we spent the 50 bucks. 65.04 divided by 50 is 130%. Okay? That's number 1. Number 2 is this scenario here. 124.74 minus 50. 24.74 minus 50 is $74.74 divided by our original investment. I just realized I made a mistake on the first one, so let me back up. Sorry about that. Somebody out there must have been thinking it. Okay, let's do it over. 115.04 minus what? 100. Remember, we've got to buy 2 positions. Our risk is $100. Okay, I was going too fast. So, $15.04, right? 15.04 divided by 100, 15%. So, 15% for what? 3 hours worth of work, okay, is scenario number 1. Now remember, you've got to keep this in perspective. Literally, okay, let's not say 15 minutes worth of work, but a day. Okay, let's say a full day, 24 hours, and you're making 15% on your money. You know,